You know, kind of wishy-washy day in Wall Street there. We erased all those gains that we saw. The dollar continuous decline. Is this all because of the Fed?
Good morning, Yvonne. Hard to predict what the markets will do on any one given day. Let's look at a few months. I mean, the Fed is likely to raise rates either in June or autumn. So we know that much. This will have a big impact on emerging markets across the world because if the dollar strengthens, a lot more money could move back to the dollar. And this week we have the Mexican Central Bank and the Philippine Central Bank looking at their rate decisions, so we could see the direction of emerging markets there. Brazil GDP comes out. I'm spending a lot of time on Brazil these days. Across the world, the rate rises is very important. This is the most important event this year. This will have an impact for India, Indonesia, and the whole slew of emerging markets in terms of what will happen to their currency. So quite an important year. It's hard to predict on one day what's happening.
Sure. You know, we've seen in a little bit of declines in the dollar, but overall, this dollar strength, you know, we've heard some Fed presidents talking about how this is kind of a game changer for them. Is this rise a level of concern for you?
It is a very important event which is happening with European QE happening in the background of US raising rates. So the two big economic blocks are going at different speeds. We are seeing a bond bubble. I mean, I always wondered if I can spot a bubble. This time with about almost $1.5 trillion being invested in negative yield bonds, which most of us, normal people, wouldn't invest in negative yield instruments. So there is something special going on here with so much being invested in negative yield government debt in Europe. So the only people who are investing in these are people who have mandate restrictions. So insurance companies and regulated mandates which cannot do anything else, they are being forced to buy these negative bond yields. Some of them will seek to change their mandates, and people who have flexibility will try to go into, say, corporate bonds and peripheral government bonds. So we will see good demand for, let's say, Portugal, Italy, etc. Greece is a little bit of its own category. But again, in this context, I see a Greek exit quite a low probability event. But of course, nothing is zero probability. There is no such thing as zero risk. But in the scheme of things, the bond bubble seems to have a lot of room to run, given that QE is still in its early days in Europe. We still got till September 2016. So this is the most interesting space to watch in Europe.
Sure. I mean, you're talking about Greece here. I mean, Angela Merkel did say that they don't want Greece to leave the Eurozone. You said you're still seeing a Grexit here, but how much time left really does Greece have until the cash runs out, really? And nobody can really tell at this point.
So my view is that Grexit is very unlikely to happen in the context of QE happening. So they don't go in the same direction. If a Greek exit happens, it will upset the calculations. The whole point of QE is to support the peripheral economies, Southern Europe, Portugal, Italy, Spain, Greece, etc. So the whole idea of that is to help these economies recover and as a whole help Europe, because these economies are part of Europe. They're all big end markets for Germany and France and so on. So they're all part of a whole. So a Grexit is very unlikely to happen. The cash flow events it's a part of a negotiation process, so it's hard to predict how the negotiations go day by day, week by week. But if you take a 2-year view, you will see that they will work through these differences. The Greek government started off at the extreme left, then they started moving towards the center. So that's kind of the picture I had in mind over the last couple of months as the government got elected.
Sure. You say you're spending about half your time on Brazil and equities now. Where else are you looking right now? Maybe in the Asia-Pacific region?
In the Asia-Pacific region, I'm looking at the Hong Kong consumer. And there's a lot of demand which has come off with lower mainland Chinese visitors to Hong Kong. So the cosmetics names there, the jewelry companies listed in Hong Kong, they're all becoming relatively weak. And here I see good long-term franchises which can survive for decades at reasonable prices. So they're very attractive. In general, in Asia, consumer names are very expensive. This seems to be a pocket of exception. So I'm spending time on some of these names. And that's where I would focus my energies.
Sure. Let's focus maybe a little bit on China here, because we're expected to get those PMI numbers coming out in about 2.5 hours or so. There is expectations that we're going to see a decline from February. How do you take it?
China is a managed economy, so I kind of look for the broad direction and don't give too much importance to any particular month's numbers. We know that the statistics are, it's heavily regulated and controlled, so we don't know how much is true at every particular month, but the broad trends would probably be right because you can corroborate it with many other different pieces of evidence. So we know China is slowing down, so they've been slowing down the GDP numbers. China is still the factory of the world. It still produces a lot of exports and has current account surpluses for the most part. The Chinese consumer over the next many years will continue to have rising spending power because they are generating real wealth for themselves with the exports which China makes. So I would stick with the Chinese consumer. I don't have any specific industrial bets on China. I think it's a bit hard to call because there's a lot of linkage to property and demand in the short term. In a 3-6 month horizon, a lot of sentiment will depend on how property prices do. So leaving that aside, a longer term trend is that the Chinese consumer is getting wealthier. So that is what I would focus on.